So mortgage rates are higher than they've been in the last couple of years. And with higher rates, that makes purchasing a home even more expensive. And because of that, there's 4 mistakes that I want you to avoid in order to make sure that you choose the best mortgage. So let's get into it. Number 1, not shopping for a home loan. I know this can be a daunting task, and let's just face it, it's not sexy. But not shopping around for different lenders is a huge mistake that I see people make. Most of the time, people are going to go with the first lender that they come across or whoever was referred to them. And again, this is a big mistake. When you shop around for lenders, you're getting the opportunity to not only get the best favorable terms, you're probably going to get the best favorable interest rate. And let's face it, not shopping around, again, huge mistake, because you don't want to wind up paying more in interest than you would normally have to. So again, talk to 3 or 4 different lenders. I'll give you an example. So when my wife and I were shopping for our first home together, we talked to 4 different lenders, including trying to go through the NACA program. And I'll leave a link to what NACA is at the end of this video. But we talked to each lender, and then we put all this information to a spreadsheet to compare rates and terms so that we can decide the most favorable one. Then what we wound up doing was taking bits and pieces from each of those and basically pitting each of those lenders against one another to come up again with the best possible rates and terms. So one lender offered us one interest rate at a certain amount of points. Another one offered interest rates at a different set of points. And so we cherry picked and said, okay, this lender X is offering us this. Can you match it? And sure enough, they wound up matching it. So if we would have went just with the first lender, we probably would have had a higher interest rate and paid more in points. That in turn relates to fees than we normally would have. So again, shopping around for lenders is crucially important. Now, when you shop around, the lender is going to vet your income. They're going to vet your finances. They're going to pull your credit just to see how much you actually qualify to borrow. So yes, they're going to pull your credit, but here's a little secret. If you shop around multiple lenders within a 14-day period, it only counts as one hard inquiry to your credit. So again, it's very imperative that you don't just go with the first lender you come across, but you want to shop across multiple different lenders. And I usually like to do 3 or 4. If you can do more, great. If not, at least 3 or 4 so that you can make a very informed decision about how your financial future is going to look as it relates to your mortgage. Number 2, stretching to buy more house than you can afford. You've gone through that pre-approval process, and let's say you got pre-approved for $500,000. You don't want to look at homes that are in the $500,000 range. Now, there's some caveats to this. If the home has been on the market for an extended period of time, then there may be a chance for you to negotiate at a lower price. But if the home has just hit the market, you probably don't get that same type of leverage. And when you're shopping at the higher end of your budget, you're going to be paying more over the long run. So back in 2020, 2021, this probably wouldn't have been a problem because interest rates were at like 2.75 to about 3.5%. Now they're essentially doubled that. So if you're paying for a house that's more expensive than what you would qualify for or right at the top of your range, again, you're going to be paying more over the life of that loan in interest than you normally would have paid if this was 2 or 3 years ago. So don't shop at the top of your budget and stretch yourself thin just to get that house that you like because it comes with all the great bells and whistles, because you don't want to regret paying for a home and stretching your budget out way beyond what you can afford. So again, don't shop at the top of your range, but look at homes that give you some buffer space. So I usually say go 20 to 30,000 underneath what you pre-qualify for. So that way you have some room to negotiate up if you want to. But if you can't, then that puts you in a more favorable condition so that you're not borrowing more and paying more interest monthly and even over the life of the loan. Number 3, choosing the wrong mortgage product. With interest rates being as high as they are today than they were a couple years ago, again, a lot of people are kind of doing some what we call creative financing. So they're looking at things like adjustable rate mortgages, and these can be a great option for you. However, you need to understand the risks that are involved with that. So let's just say you get a mortgage at today's rate. Let's call it 6.75. I don't know if that's actually true, but that's right around where we are in today's rate range. So let's say you get a rate that's 6.75, but you do an adjustable rate mortgage that is going to reset in the next, let's say 5 or 7 years. Now, you're going to have teaser rates that'll keep you at, let's say, 4.5% to maybe 5% for the next, 7 years. And then that rate's going to reset to whatever the prevailing rate is at the time. So again, I said 6.75. So assuming that you're paying 6.75 over 7 years, no harm, no foul. But what if in year 7, rates shoot up to 8%? Now you're in a little bit of a bind, because if 6.75 was already stretching your budget, 8% is going to push you to the brink of foreclosure. And we don't want to see that. So again, these rates could be cool if interest rates go down, because now you have a chance to capture the lower rate, or you may be able to refinance out of that rate to the lower rate, thus saving you money over the long run. But again, you're taking a little bit of a gamble. Similarly, there are now 40-year mortgages as opposed to 30-year mortgages. Now, the interest rate on a 40-year mortgage is going to be a little bit higher. So you're going to pay more over the life of that loan. So that extra 10 years, you're paying extra money. So it might not be worth it for you. And it may make sense if you're like in your 20s and you plan on being in a house for like 20 years. But for other people, not so much. Now, again, there's a chance for you to basically refinance out and capture a lower interest rate and shorten your terms. But when you do that, you're probably going to have a higher monthly payment. So having a 40-year kind of takes some of the flexibility away of some of the things that you possibly could do. Now, if you're getting a better job and things are going well for you, this could work out great. But again, you just want to be very careful about the type of loan product you use so that you're not caught short should the economy shift or the financial market shift or your job situation or income situation change. You just want to make sure that you're picking the right mortgage over the long run. And none of us really know what's going to happen, but there's some wise decisions that you could make when you do your due diligence, okay? Number 4, not practicing your monthly mortgage payments. For first-time buyers, with interest rates where they are, there's a chance that you're probably going to pay more in a mortgage than you would be paying in rent. So here's an example. If your rent, let's say, is $2,000 a month and your mortgage is going to be $3,000 a month, you need to practice putting that extra $1,000 into savings or something where you know you can make that payment each and every month, so that when you become a new homeowner, that process is not unfamiliar to you and you understand what it takes to make that commitment over the next 15, 30, or 40 years every single month. Sometimes people will think that they can afford it, but then when it actually comes down to it and the rubber hits the road, they wind up realizing that this is a little bit of a stretch, because with that higher mortgage that you're going to pay over your rent, you're also going to have some other, what I call, total cost of ownership for owning a home. So no longer can you depend on your landlord to cover your water heater or broken pipes or anything like that. That now comes out of your dime. So there's some other essential expenses that are going to come along with being a homeowner, and you kind of got to budget that in per se. Now, you won't know what those things are, but you need to have some buffer room every single month. If you're living check to check and you're going into home ownership, that's a very bad idea. Again, you just want to do your due diligence in making sure you can afford those monthly mortgage payments and having some extra at the end of the month so that you're not stretching yourself too thin, and being able to make sure that you are not going to be a victim of foreclosure. So those are the typical 4 mistakes that I see a lot of home buyers make. But the truth is that you can avoid all 4 of these mistakes by just practicing and doing due diligence. This is going to ensure that you get the best loan and rate terms as possible. And with interest rates higher than they were in the past couple of years, this can help you have some reasonable accommodations each and every month so that you make sure that you're not stretching yourself and you don't wind up having buyer's remorse for purchasing that home. So I hope this helps, and I wish you guys happy house hunting.